Today is Saturday, February 22nd, 2020. Are the Bulls losing steam? We will talk about that. And this is your 2-minute drill. Hey, I'm Jonathan Gurney, the portfolio manager at Gurney Financial. The purpose of these videos is to educate and keep clients aware of what is happening in the stock market. Our goal is to close the gap in communication between clients and the actual person managing their assets. We use fundamentals primarily and technicals as part of our analysis. We hope the charts and education help clients and viewers alike. Friendly reminder that this video is not to be taken as financial advice. Should you have questions, feel free to reach out to us through email or social media comment section. If you have questions about our firm, check out our FAQ section at gurneyfinancial.com. We are going to dive directly into it. We have a lot to cover. It was an interesting week. It was a shortened week with President's Day on Monday. So we're going to dive in. Here was Friday. So we don't have a weekly performance because there was only 4 days. So that's a little bit frustrating, but it is what it is. So this is Friday's performance. Obviously, the NASDAQ performed the worst, but we'll give you a better perspective. Again, our goal is to show you the realistic picture. We're going to have days like this. That's just the reality. But if I were to show you the year to date over 2 months and 22 days, it's very clear that the NASDAQ is the winner. We are fortunately heavily weighted there, but we also do have a decent amount of cash for dips such as this. So kind of interesting perspective. The 4 major indexes, the Russell 2000, the Dow, S&P 500, and the NASDAQ. And we do have heavily weighted here, but we still have a decent amount in cash as well. We actually have about 40% in cash currently. So we actually feel very good about where we stand with this little dip that we're having. I want to shift to sector performance. This was Friday. This is classic. This is what you're going to see during a little pullback. So you're seeing risk off areas in real estate, consumer staples, healthcare, utilities. This is what you normally see. They usually outperform on ugly days. And the risk on assets sectors are going to underperform, which is what happened. Technology struggled after significant outperformance. We do believe momentum is a little bit extended here, but these are good pullbacks, and we'll see if some of those momentum names come back next week. That's really what we're going to be watching closely. But if we shift to the year to date, I'll watch this completely shift. Again, utilities, interesting enough, has been fantastic, which is a risk-off asset. Just people continually trying to get yield. Again, the problem is treasuries are so low in their yield that people that are usually more conservative have to reach into other areas like dividends in the S&P 500, so on and so forth. So that's very interesting, not surprising to see, in my opinion. These two at the top, I have a lot invested in both of these. But overall, in general, risk on areas did the best. With energy significantly lagging, still not interested in that area. So we're going to hit into price action now. We'll discuss that for a little bit, and then we'll get into the 2-minute drill. So thanks for your patience. It was an interesting week. Again, it was a shortened week. We basically, throughout the week, have been saying watch the range between 33.88, which is this red area right here, 33.88 on the S&P 500, and 33.50. We traded here for quite a few days, tested highs and lows within that range. We did break out Friday below that level, and we are testing the 20-day moving average. So it's very interesting because from an emotional standpoint, it's almost comical because you have the same people that were saying, hey, I have a fear of missing out on higher gains. And then they're like, okay, I feel like you should be selling now after a 2% dip. So watch your emotions here. That's what I will say. We are in a great position because we have a lot in cash. Some people would say, why didn't you add more in cash? Because it still could have gone higher, and I don't have a crystal ball. There's your answer. That's just the reality. But keep it simple. There's nothing crazy that's happening here. There is a little more fear on the coronavirus. That's the reality. Personally, the last couple weeks, I felt like this move was a little bit extended higher, which is why we raised a little more cash. And we are simply testing the 20-day moving average at the 33.34 level right here. So we touched that and we closed above that. We did go a little bit lower and then tested above. So to answer the question of the entire series, I don't think bulls have lost the grip of the market yet, but there is a battle right here at these levels. It's unfortunate that we closed below the 33.50 level, but we are still holding key levels, and this could quickly bounce back. Again, 6 out of the 8 last Friday's trading days have been down. So it's not there's a lot of concern, people going into a weekend with the coronavirus, people selling a little bit. So we'll see what Monday brings us. There's been a lot of positive Mondays, so we'll see if this can turn around. But again, the move this year has been fantastic. Support we're watching, 33.34, the 20-day moving average. The mid Bollinger Band, 33.23. The gap up, which is right here, this area right here, 33.12. The reason why we watch those levels is usually gap ups get retested. And the 50-day moving average, of course, which we've seen recently on the coronavirus news. Could we test it again? Yes, it's actually a very important level because it's a 50-day moving average and the gap up level. So it'll be interesting. So the gap up here and the 50-day moving average, one and the same. So just wanted to show you those things. And one more educational piece that we wanted to show you is the 8 and 21-day moving average to see, have those crossed. We were getting a little bit extended with the 8-day, making a pretty significant gap above the 21-day. So we're not in a concern here. This actually concerned me more when we were here. In fact, we actually were very, very close to crossing. This was more of a red flag to me. We're not out of the woods yet. I don't believe bears have the tape at this point yet. But if they do take over, we will react accordingly. So again, take your politics, take your opinions, I think the market is too highly priced out of the equation, and simply watch price action. It takes the emotion out of it. When you watch price action, you do less watching your account value. You're going to lose your mind if you watch your account value every day. So don't do that. All right, so we're going to move into the 2-minute drill. Let me get my, let me shift gears here real quick. Okay. Growth versus momentum. We've been paying attention to this. Value versus momentum. Value is the red. We've been in a consolidation period, moving sideways with value. And we basically said, could value break out and make us go higher? What actually happened was growth went a little bit, momentum went a little bit higher, and value just struggled a little bit. So could we see a little more? It would be interesting to see if Monday in this coming week, if value does get a bid. But we're keeping an eye on this because this is a big, very big move and catch up in momentum names over the last several months. So we're watching that closely. It'll be interesting to see if value gets a bid. Put call ratio finally got out of some lower levels. So some would argue when we're in this yellow area that there's some complacency. It doesn't take much for a pounce higher for people to protect their portfolios. That is happening. Could it go much higher? Obviously, yes. That's a very quick version. Wouldn't be surprised to see a little more fear out there. Wouldn't be surprised to see the VIX go up a little bit more. Here's the VIX. Again, we've said in the green area, the market tends to do well when the VIX, the fear is in these levels. We get a little complacent around the 11s. So we did have a nice pounce in the VIX, which it's good to see some fear out there. The market is real. The market is reacting to the coronavirus, and that's completely fine. Gold has been on a tear after a period of consolidation. Full disclosure, we do own some. Impressive sideways movement with a breakout. This is textbook price action. So over the last 2 months, we've been trading in a relatively close, tight range, tested that same level, and continue to break out. So again, we don't view this as a long-term hold personally. We view this as a short-term, hey, let's protect our portfolios. But it's been interesting because the market has gone up significantly, and so has gold. So for all those that think that gold is the time to buy when the world is ending, not always the case. People often protect and just view this as, hey, price action looks good. I think it's going higher. So just wanted to disclose a few of those things. Interesting chart of the week that we wanted to show you. So this is showing breadth of stocks outperforming the index, meaning the S&P 500. So percentage of stocks outperforming the index. Kind of interesting. Over the last 3 months, fewer than 40% of the S&P 500 component stocks have beaten the index. In short, if you think the market is easy to beat, it is not. Fortunately, we have, because we were in the right areas in the NASDAQ, not directly in that NASDAQ, but many tech names. So this isn't to scare you. It's just to give a realistic perspective. And so we're going to go to the next chart that said, hey, when this happened previously, when we had breadth of stocks outperforming the index less than 40%, what did the S&P 500 do? Less than 40, we had a dip. Less than 40. Again, you could look at so many charts that are bullish at this point as well. In fact, usually when you see a 1.5-year period of consolidation, the market goes much higher than we already have. So don't have your assumptions based off this chart. It's very interesting, and I will be watching closely the price action. Just kind of an interesting tidbit. This could easily turn around quite quick if there's any positive news in the coronavirus, because fundamentals remain extremely strong and the Fed is helping. That's just the reality. So we appreciate your trust. One quick thing real quick. This is our diversified portfolio. This shows you since May 2017. The blue is us, the red is the S&P 500. I'm not doing anything crazy like Bitcoin or anything like that. Doesn't mean you can't make money in Bitcoin. I want to make that very clear. But these are basically good quality names that we saw opportunity in. So 66.9 versus a 50.1. The point is not to boast of performance. The point of this is to show you, hey, this, despite a 60, what did that show? Despite a 66, almost 67% gain over 2.5 years, call it. There are periods where you're going to see 20% dips. I don't know if this is one of them, but we have a lot in cash, so we're in good position. So we're going to go into this next week with an open mind, not based on the last 2 days. We're going to take each day as it comes at us and invest accordingly. So appreciate your trust. Let us know if you have any questions along the way. We're here for you. Hopefully this is educational and helpful. Thanks so much for your support.